Next question. Sensex futures are traded at multiple of 5050, that is lot size is 5050. Consider the following quotations of Sensex futures in 6 trading days during February. Starting from 4th of February to 11th of February, high price is given, low price is given, and the closing price is given. Abhishek bought, that is purchased, one Sensex futures contract on 4th of February. The average daily absolute change in the value of the contract is 10,000 and standard deviation of these changes is rupees 2,000. Maintenance margin is 75% of initial margin. You are required to determine the daily balances in the margin account and the payment on margin calls, if any. That is a question. Please go through the question, all of you. Now friends, over here the question is providing the information that a trader, an investor called Mr. Abhishek, entered into the transaction for purchase. Now what is the price at which the purchase contract has been entered upon is not given to us in the question. So we make a simple assumption that you have entered into the transaction to buy at the closing price, that is 3296.50. So of course you are required to make the payment of only initial margin on 4th of February, nothing else. Then on daily basis we are required to make a comparison between the closing prices. The information about the high price, information about the low price have been just provided to confuse us. It is of no use to us. So we have to focus on the closing price. Okay. The second thing that we have been provided over here is average daily absolute change in the value of the contract is 10,000 and standard deviation is given. So these are the statistical values which have been provided to us, which is given a name as mu, that is we understand is like x bar, and standard deviation information is given to us. So basically over here the initial margin will be calculated as mu plus 3 standard deviation. This is the way we are required to compute the initial margin. What is the value of the mu? It is an amount of 10,000 plus 3 into standard deviation, that is 2,000. So 3 into 2, that comes to 6,000. So 10,000 plus 6,000. This is the way the initial margin of 16,000 will be calculated. Basically we understand that so the standard deviation is a statistical term which is indicating the volatility. So over here mean value is basically plotted exactly in between, that is x bar. Then x bar plus or minus 1 standard deviation, 2 standard deviation and 3 standard deviation. So x bar plus or minus 3 standard deviation is indicating that say maximum volatility in the price can be equal to this much, and it is covering say approximately 99%, even more than that. In our VAR, value at risk, we study this point that say the x bar plus or minus 3 standard deviation is covering 99% chances. So accordingly, so the amount of the initial margin is calculated, and then the maintenance margin is 75% of the initial margin. So write down answer of the question. Working note number 1. Calculation of initial margin. कैसे किया जाएगा उसको? Mu plus 3 standard deviation. Mu means x bar, which is provided over here 10,000 plus 3 standard deviation, that is 3 into 2,000. So this is the ready-made formula which they are following so as to cover the maximum risk of the price fluctuation. That comes to rupees 10,000 plus rupees 6,000. rupees 16,000, that is initial margin. Second working note is calculation of maintenance margin. Maintenance margin will be found as initial margin into 0.75. Initial margin is 16,000 into 0.75, that comes to rupees 12,000. That is the way the maintenance margin is calculated. After that, write down, assuming that futures contract is entered upon at closing price of 4th of February, comma, amount of profit or loss is calculated. So we already have prepared the two working notes. The first working note is initial margin, second working note is maintenance margin. Working note number 3 will be calculation of the profit or loss on daily basis. So in that, again the column number 1 is date, column number 2 is sale price, column number 2 is purchase price, then profit or loss for every 1 unit, and then in total profit or loss. That is taking into account the lot size and taking into account the number of contracts. Lot size is provided as 5050, and so the number of contracts is 1, because the question is providing the information that say Abhishek bought 1 Sensex futures. How to make the calculation of the Sensex is also what we are going to cover later on. So I want you to complete this working note number 3, and then I want you to prepare the margin account. So let us see that say how to do answer. The question is providing that say you have entered into the transaction to buy. We are assuming that say on 4th we have purchased it at the rate of 3296.50. The closing price is same 3296.50. So the amount of the profit or loss will be 0, and in total the profit or loss will also be 0. On the next day the closing price is 3262.50. So we are making an assumption on behalf of the stock exchange that say, let us say on the very next day the trader is squaring off the position. So what will happen, the sale price will be 3262.50 and 3294.40, 3294.40, and the purchase price will be 3296.50. It is 3296.50. So difference of both of them is the profit or loss that you will have, 3294.4 minus 3296.5. So there is a loss of 2 rupee 10 paise. Lot size is provided as 5050 and number of contracts are 1. So the amount of the loss is 105. Next day the closing price is 3212.30. So assuming that is the price at which, say, he enters into the square of the transaction, that is 3212.30. The purchase price is going to be 3294.40. So 3212.30 minus 3294.40. So that is a loss of 82 rupee 10 paise. 3212.30 minus 3294.40 multiplying with 50 into 1. So in total there is a loss of 4105, and so on we are required to make further calculation. So next day on 7th, the closing price is 3267.5. 3267.5. The purchase price is going to be 3213.30. 3212.30. So difference of both of them is profit of 55.2 into 50 into 1, that comes to 2760. Next date is 3257.8. This is the purchase price 3267.5. So 3257.8 minus 3267.5. There is a loss of 9 rupees 70 paise into 5050 into 1, that comes to loss of 485 rupees. Next date is 3102.6. So 3257.80. 3102.6 minus 3257.8, difference of both of them is 155.2 into 5050, 7760. This is the way we are required to make the computation of the profit or loss on daily basis starting from 4th to 11th. Next day it is margin statement. In that, column number 1 is date, column number 2 is particulars, third column is amount. So you start on 4th of February with the payment of initial margin. How much margin you are going to pay? 16,000. On 5th, say there is a loss. Loss is 105. After deducting the loss of 105 from 16,000, the balance is 15,895. So this is the closing balance. There is no margin call. Why? Because say the balance is not reducing below 12,000. On 6th, there is an amount of loss, once again 4105. So minus 4105. So the balance is 11,790. So this is a closing balance before margin call. On 6th, you are required to make the payment of margin, that is Mr. Abhishek. Why? Because the balance has fallen down below 12,000. So payment of margin in such a way so that the closing balance is equal to initial margin, that is 16,000. So it comes to 4210. This is calculated as balancing figure. Next, on 7th, there is a profit of 2760. So again on 7th, the closing balance is 18760. So there is no question of margin. On 8th, there is a loss. $485. So the closing balance is not falling below maintenance margin. So there is no question of payment of margin. 18275. On 11th, there is a loss, 7760. So on 11th, the closing balance before margin call it is 10515. So on 11th, you are required to make payment of margin. Margin is required to be paid for such an amount so that the closing balance is equal to initial margin. So 16,000 minus 10515, that is 5485. So on 11th, closing balance is 16,000. This is the way we are required to compute the closing balance. So this is the way we are required to compute the closing balance. Just for understanding purpose, if at all we compute the profit or loss in the futures contract, then again we understand like this. Let us say that on the last stage you say square off the transaction. Then what will happen? This is the price at which you have entered into the transaction to buy, that is purchase. So this is the price at which you are going to sell. So use your calculator. 3102.6 sale price minus 3296.5 purchase price. So there is a loss of 193.9 into 5050. So that comes to 9695. Over here there is no, that is a intermediate cash flow. So you can very well understand that is cash inflow. Cash outflow is definitely there. So the amount of the loss that we already have found is 9695. Let us verify it. Payment of the initial margin. So use your calculator. 16,000. Then again you have made payment of margin 4210. So plus 4210. Again you have made payment of margin 5485. So the total payment that you have made is 25,695, and 16,000 is what? So you have got when you entered into the reverse of the original futures contract, that is in square off. So difference of both of them is exactly 9695. This is the way you can have the cross verification of the answer.